Listen, stop what you're doing right now. I don't care if you're in the middle of something important. I don't care if you think you've seen another silver video and you already know what's coming. I don't care if you're the person who watches these with one eye while doing something else. Not this time. This time you put everything else down. You sit down and you give me your complete undivided attention for the next 15 minutes. Because what I'm about to walk you through is not a price prediction. It's not a bullish silver video telling you silver is going to the moon and you should back up the truck. What I'm about to give you is something far more important than that. This is a preparation guide, a survival guide, a roadmap for what is coming in the silver market over the next 30 to 90 days that is going to test every single silver holder in ways that most of them are completely unprepared for. I'm going to tell you right now with complete honesty and zero sugarcoating that some silver holders are going to come out of what's coming stronger, wealthier, and more financially secure than they've ever been in their lives. And some silver holders are going to get absolutely destroyed. Not because they were wrong about silver, not because the thesis was incorrect, but because they were unprepared, because they didn't understand what was coming, because they made emotional decisions instead of strategic ones at exactly the wrong moment. And the difference between those two groups, the difference between the people who thrive and the people who get destroyed, is what I'm going to show you today. Before we get into it, if you want to stay ahead of what's coming in the silver market and understand what the COMEX data is actually telling you right now, smash that subscribe button and turn on notifications immediately. I'm about to show you numbers that should be on the front page of every financial newspaper in the world and somehow aren't. Drop a comment right now telling me how you hold silver, whether that's physical ETFs, miners, or futures. Because the preparation steps are completely different for each situation, and I need to know who I'm talking to. Here's where we are. Today is February 13th, 2026, Valentine's Day coming. While most people are thinking about flowers and dinner reservations, I'm sitting here staring at data from the COMEX, from the US Mint, from industrial demand reports, from the options market, from physical dealers across the country. And all of it, every single data point is pointing to the same conclusion. Something is coming in the silver market. Something big. Something that is going to make January's volatility look like a minor speed bump. And if you hold silver, you need to prepare for it right now, today, before it arrives. Where silver actually stands right now. As of this morning, February 13th, 2026, silver is trading at $7,853 per ounce on the COMEX spot market. Let me give you some perspective on that number because, without context, $7,853 means nothing. On January 29th, just 16 days ago, silver hit an all-time record high of $12,164. Then it crashed hard into the mid-60s. And today's 78.53 represents a market trying to find its footing after a 3.85% rally just yesterday on Friday, February 13th. That recovery, that moved back up through the 70s, is not just a price recovery. That is buyers and sellers fighting over a price level in a market that just demonstrated it can move violently in a single session. That is the coiled spring recompressing after the January explosion. And what you need to understand, what you absolutely must understand if you hold silver, is that this compression is temporary. The spring is loading again. And when it releases, the move is going to be just as violent as January, maybe more violent. The COMEX data nobody is talking about. Now let me show you the data, because data doesn't lie. Politicians lie, banks lie, the mainstream media lies, but numbers on a spreadsheet don't lie. And the numbers I'm looking at right now are telling a story that every silver holder needs to hear urgently. As of February 13th, 2026, the COMEX registered silver inventory, that's the silver actually available for delivery against futures contracts, stands at 28.4 million ounces. Let me put that number in context. Just 3 weeks ago on January 24th, registered inventory was 124 million ounces. Today, it's 28.4 million. That is a decline of 95.66 million ounces in 3 weeks. 3 weeks. That is a 77% decline in registered silver inventory in 21 days. Write that again. 77% in 3 weeks. The COMEX just lost 3/4 of its deliverable silver inventory in less than a month. And nobody's talking about this. CNBC isn't covering it. Bloomberg isn't running headlines. Your financial advisor hasn't called you because the people who benefit from you not knowing this information don't want you to know it. But the paper-to-physical ratio is where this gets truly alarming. The total open interest in COMEX silver futures as of yesterday is 138 by 400 contracts. Each contract represents 5,000 ounces. That's 692 million ounces of paper silver claims. 692 million ounces of paper claims against 28.4 million ounces of registered physical silver. That is a ratio of 24.24 to 1. 24 paper claims for every physical ounce sitting in the vault. 3 weeks ago, it was 22 to 1. And I was telling you that was dangerous. Now it's 24.4 to 1 and accelerating. And here's what really should make you sit up straight. If just 4.1% of those paper contract holders decide to stand for delivery instead of rolling or cash settling, the COMEX is completely out of silver. 4.1%. That's not a black swan event. That's not some extreme, catastrophic scenario. That's a relatively minor shift in behavior among futures traders. And based on what I've been seeing in the delivery data over the last 3 weeks, we might already be past that threshold. Because in the last 3 weeks, delivery demands have been extraordinary. The 95.6 million ounce decline in registered inventory didn't happen because the silver evaporated. It happened because people took delivery. Real people, real institutions, real industrial buyers demanded their silver and took it out of the COMEX vaults. They pulled it off the exchange. They said, "I don't trust the paper system. Give me the metal." And the COMEX gave it to them. Until now, it still could. But at 28.4 million ounces of registered inventory against 692 million ounces of paper claims, the ability to keep delivering is becoming mathematically impossible. And February 26th, the March 1st notice day, is just 12 days away. Drop a comment below right now and tell me if you knew the COMEX registered inventory had dropped 77% in 3 weeks. Because if you didn't, and most people don't, and then you understand exactly why this video exists, the US Mint, a shortage confirmed from a different angle. Now, let me show you what's happening at the US Mint, because this confirms the shortage from a completely separate direction. The US Mint produces American Silver Eagle coins, the most popular silver bullion coins in the country. In January 2026, during the height of the silver mania, when prices were approaching 120 tules, the Mint sold just 1.88 million silver eagles for the entire month. That's historically low for a period of high investor interest in silver. Why were sales so low during a silver price explosion? Because the Mint couldn't produce more coins. They didn't have enough silver blanks. The refineries supplying the blanks were completely overwhelmed. And now in February 2026, with silver back in the high sevens and investor demand still strong, the Mint is reporting continued rationing. Dealer allocations have not increased despite recovering prices. The Mint is still operating under constrained supply conditions. The silver that feeds the coin production pipeline is simply not there. I spoke to several major coin dealers this week. Their feedback was unanimous. Premiums on silver eagles are still running $8 to $11 above spot. That's a 10% to 14% premium on a coin when silver is at $78.50. In a normal market, silver eagle premiums are $3 to $4 above spot. These elevated premiums are not normal. They're a distress signal. They're the physical market screaming that silver is genuinely scarce, while the paper market tries to pretend everything is fine. One dealer I spoke to told me he had orders from customers totaling 45,000 ounces that he simply cannot fill. He has the orders. He has the customer's money. He just doesn't have the silver. Another dealer told me his reorder lead time from the Mint has gone from the normal 2 to 3 weeks to 11 weeks. 11 weeks. Nearly 3 months to get silver from the US Mint. Does that sound like a market where silver is plentiful? Or does that sound like a market in the early stages of a genuine shortage crisis? The sleeping giant, industrial demand, that can't stop. Now let me show you what's happening with industrial demand, because this is the factor that is going to overwhelm everything else. According to data released by the Silver Institute this month, industrial silver consumption in 2025 reached 698 million ounces. That's the highest level ever recorded, higher than 2024's record of 680.5 million ounces, higher than any year in the history of the silver market, and the projection for 2026 is even higher. The Silver Institute is forecasting industrial demand of 720 to 740 million ounces for 2026. Solar panel manufacturing consumed 235 million ounces in 2025. Global solar installation capacity is set to reach 670 gigawatt in 2026, up from 520 gigawatt in 2025. That's a 29% increase, which translates directly into approximately 300 million ounces of silver consumed by solar panels in 2026. Electric vehicles, EVs, consumed 74 million ounces in 2025. Each EV uses 30 to 50 g of silver versus 15 grams in a combustion engine vehicle. Global EV sales projected to reach 23 million units in 2026, a 26% increase, translating to approximately 93 million ounces. AI and data centers. AI-related silver demand consumed 22 million ounces in 2025 and is expected to reach 28 to 30 million ounces in 2026, a 27% to 36% increase. Add it all up. Solar at 300 million, EVs at 93 million, AI and electronics at 30 million, medical and other industrial at 320 million. Total industrial demand in 2026 is approaching 745 million ounces. And total global silver production in 2025 was 1.0303 billion ounces. Industrial demand alone consumes 72% of all silver produced before investment demand, before jewelry, before coins, before anything else. This is a permanent structural shift in the silver demand landscape that has no precedent in the history of this market. If this data is landing with you, smash that like button right now and share this video. This channel is where you get the complete picture. Subscribe with notifications on because the next 12 days are going to be defining the global picture. What the world is really paying for silver. Silver is a global commodity, and what's happening around the world right now is absolutely critical to understanding what's coming. China export restrictions tightened since January 1st, 2026. The Chinese government is not just requiring export licenses. They're simply not issuing them. Silver that enters China does not come back out. Shanghai silver is trading at the equivalent of 92.35 per ounce, while COMEX is at 78.53. That's a 1380 tile premium, a 17.6% premium of Shanghai over New York on the exact same metal. India buyers in Mumbai are paying the equivalent of approximately 205s at $1 per ounce, more than triple the COMEX paper price. That's a 218% premium. Indian buyers who have 5,000 years of experience understanding what happens to paper money are paying whatever they have to pay to get real metal. Middle East dealers in Dubai and Riyadh are reporting premiums of 40% to 60% over spot prices. Buyers from Saudi Arabia, UAE, and Kuwait are all trying to accumulate physical silver as the petrodollar system continues its slow motion unraveling. The verdict is this: the COMEX spot price of 78.53 is increasingly irrelevant to the real-world silver market. The real price of silver in the real world is $92.35 in Shanghai, $235 in India, $110 to $125 in the Middle East, and $86 to $90 at a U.S. coin dealer when you factor in premiums. The COMEX price is a fiction maintained by paper contracts and leverage, and it's a fiction that's becoming harder and harder to sustain as the physical shortage intensifies on every continent simultaneously. The 4 triggers that could detonate everything. Now let me tell you about the triggers that could make everything collapse very quickly, because what I've shown you so far, the COMEX inventory at 28.4 million ounces, the 24.4 to 1 paper to physical ratio, the record industrial demand, the global price premiums, all of it is the spring being compressed. But compressed springs don't release slowly, they release suddenly. Trigger number 1, March COMEX delivery period 12 days away. The March silver futures contract is approaching first notice day on February 26, 2026. The March contract currently represents open interest of approximately 72,000 contracts, which is 360 million ounces of potential delivery demand against 28.4 million ounces of registered inventory. Even if only 10% stand for delivery, that's 36 million ounces demanded from a vault that has 28.4 million. The math doesn't work. Trigger number 2. Major industrial user discloses supply problems. I'm hearing from industry contacts that at least 2 major publicly traded companies are going to disclose silver supply constraints in their upcoming earnings reports. When a major technology or clean energy company tells Wall Street they're having trouble getting the silver they need, the price is going to explode. Trigger number 3. Sovereign wealth fund makes a large public silver purchase. There are credible reports circulating in the institutional investment community that at least one major sovereign wealth fund, managing hundreds of billions of dollars, is in the process of allocating a significant portion of its portfolio to physical silver. When that announcement becomes public, the demand surge is going to be immediate and overwhelming. Trigger number 4, US dollar weakens. Further, the dollar has been temporarily stabilized, but $36.22 trillion in national debt, $2.1 trillion annual deficit, inflation running above target, these problems haven't gone away. If the next inflation data comes in hot, if there's a banking stress event, the dollar could reverse quickly. And dollar weakness is rocket fuel for silver prices. Any one of these triggers could happen in the next 12 to 90 days. And when any of them fires, the silver price is not going to move up 5% or 10%. We're talking about silver going from $78 to $100 in TAL to $130 in a matter of days. Physical premiums exploding to $20, $30, $40 over spot. Dealers selling out completely and unable to replenish inventory for months. Drop a comment and tell me which of these 4 triggers you think fires first, because the answer determines the timing and velocity of what comes next. The 6 steps you need to take right now. This is what's coming. And preparation doesn't mean panicking. Preparation means having a specific thought-out plan for each scenario, so that when it happens, you don't make emotional decisions that destroy your wealth. Here are the 6 steps you need to take immediately. Step 1. Immediately audit every form of silver you own. Pull up a piece of paper right now and write down every silver position you have. Physical coins and bars in your possession. Allocated storage at a vault. Unallocated pool accounts, SLV shares, PSLV shares, silver futures contracts, silver mining stocks. Write all of it down because each of these forms carries completely different risk during what's coming. Physical silver in your personal possession is the safest. It cannot be rehypothecated, it cannot be seized by an exchange, it cannot be force majeure cash settled. Hold it, cherish it, don't sell it during volatility. Allocated storage at a reputable vault is second safest, but verify that it's truly allocated. Get the specific bar numbers assigned to your account. Confirm in writing that your bars cannot be lent out or rehypothecated. Confirm the insurance coverage. Unallocated pool accounts are dangerous. If you have silver in an unallocated pool at a bank or dealer, you don't own specific silver. You own a claim on a pool that is almost certainly fractionally reserved. Convert to allocated or take delivery immediately. Because when the shortage hits its peak, when everyone tries to convert at the same time, you'll get cash settled at the paper price, while physical trades at triple that amount. SLV shares held at JP Morgan are the most dangerous paper-silver exposure you can have. JP Morgan is one of the largest silver short sellers in the world. They have been prosecuted multiple times for silver market manipulation. In a genuine silver crisis, do you really trust them to prioritize your SLV redemption over their own survival? Silver futures are the most dangerous position of all right now. With the March delivery period approaching and registered inventory at 28.44 million ounces against 692 million ounces of open interest. Holding long futures positions through the March delivery period is playing Russian roulette with a force majeure declaration. Step 2. Secure your physical silver storage. Immediately, if you have physical silver at home, make sure it's properly secured. Not in a shoebox under the bed, in a proper safe, bolted to the floor or wall in a location that's not obvious. The higher silver prices go, the more attention it attracts. The more people talk about silver, the more theft risk increases. Secure your metal properly and don't tell people you have it. Operational security matters more than most people think. Step 3. Establish relationships with physical dealers before you need them. Right now, today, call 3 to 5 reputable physical silver dealers. Introduce yourself. Tell them you hold physical silver and you'd like to establish a relationship. Ask them about their current inventory levels, their premiums, their buying policies. Find out what they pay for silver eagles, for bars, for generic rounds. Find out their process for large transactions. Why? Because when the explosion happens, when silver goes from $78 to $130 in a week, you're going to want to know exactly which dealer to call, what they'll pay, and how quickly they can process a transaction. You don't want to be Googling silver dealers near me when prices are moving $10 a day and everyone is panicking. Step 4. Decide in advance what you will do in each scenario. This is the most important psychological preparation you can do right now. While you're calm, while the market is relatively quiet, you need to make decisions about how you will respond to specific scenarios. Because when those scenarios happen, you will not be calm. You will be emotional. And emotional decisions are almost always wrong decisions. Write these down. If silver goes from $78 to $130 in the next 30 days, what will you do? If silver crashes from $78 back to $50 due to another paper market manipulation, what will you do if the COMEX declares force majeure and cash settles paper contracts? What will you do if a major industrial buyer announces a silver shortage and prices gap up to $150 overnight? Will you sell some physical to take profits? The specific answers don't matter as much as the fact that you have answers. Because having a pre-decided plan means you execute the plan when the scenario happens, instead of freezing or panicking. Step 5. Manage your position size and liquidity. The silver market is about to become extremely volatile. We've already seen violent swings in a single day. And if your silver position is so large that a 30% swing wipes out your ability to pay your mortgage, your car payment, your kids' tuition, then your position is too large. Not because silver is a bad investment, but because you've concentrated too much risk in a single volatile asset. Make sure you have enough cash and liquid assets outside of silver to cover 6 to 12 months of living expenses. Make sure that even if silver had a catastrophic drawdown, you could survive financially, because surviving a drawdown is what allows you to benefit from the eventual recovery. Step 6. Understand the tax implications before you sell. Physical silver is taxed as a collectible in the United States. That means long-term capital gains on physical silver are taxed at a maximum rate of 28%, not the 15% to 20% rate that applies to stocks and other assets. That's a significant difference. Talk to a tax professional. Now, before you sell anything, understand your cost basis, understand your holding period, understand whether you have any carry-forward losses that can offset gains. What actually happened? The counterattack explained. Now, let me address something directly because I know some of you are thinking it. You're thinking you've been bullish on silver for months. Silver went to $120 in January, but then it crashed hard. So what happened to the squeeze? Was it all wrong? No, it wasn't wrong. Here's what actually happened. The thesis was correct. The squeeze did happen. Silver went from $29 in November 2024 to $12,164 in January 2026. That's a 320% gain in 14 months. The physical shortage was real. The industrial demand was real. The COMEX pressure was real. All of that was right. What we didn't anticipate was the ferocity of the counterattack. The banks, cornered and facing a catastrophic losses on their short positions, used every tool available to them to stop the squeeze. They dumped billions of dollars of paper contracts in the thin overnight market. They coordinated with the media to create negative narratives. And they succeeded in triggering a violent crash that shook out a massive amount of retail long positions. But here's what they didn't accomplish. They didn't fix the physical shortage. The COMEX registered inventory didn't go back up to 124 million ounces after the crash. It went down from 124 million to 28.4 million. The physical shortage got worse during the crash because the crash triggered a buying frenzy in the physical market. Smart money saw the artificial price drop and bought physical silver hand over fist. They took delivery. They pulled silver out of COMEX vaults. So the banks won the battle. They crashed the price and protected their short positions temporarily. But they're losing the war because every day that passes, the COMEX has less silver. Every delivery that gets processed drains the registered inventory further. And now, with only 28.4 million ounces left and the March delivery period 12 days away, the banks are in a worse position than they were before the crash. They bought themselves time, but the time is running out. Full transparency. What I'm doing with my own silver. Let me tell you what I'm doing personally with my own silver. Not financial advice, just transparency, so you understand where I'm coming from. I'm holding every ounce of physical silver I own. I didn't sell at 121s, I didn't sell during the crash, and I'm not selling at 78 at 53 because I bought physical silver for long-term reasons that haven't changed. The COMEX is depleted, industrial demand is at records, the supply deficit is in its 5th consecutive year, China has restricted exports. The monetary system is fragile with 36.2 trillion in debt. None of that has changed. What has changed is that I have a much clearer picture of the risk. I now know that silver can crash violently in a single day when the banks throw everything they have at it. I now know that leverage in this market is suicidal. I now know that paper, ETFs, futures, unallocated accounts, all of it carries risks that most investors underestimate. And I've used this period of relative calm to prepare. I've secured my storage. I've established dealer relationships. I've made my decision framework. I know exactly what I will do if silver goes to $130, if it crashes to $50, if the COMEX defaults, if a major industrial shortage is announced. I'm prepared. Are you? The countdown, 12 days. This is the situation as of February 13th, 2026. Here are the numbers that matter. Silver spot price COMEX, 78.53 per ounce. COMEX registered inventory 28.4 million ounces, down 77% in 3 weeks. Paper to physical ratio 24.4 to forward March 1st notice day, February 26th to 12 days from now, 20 to 26. Industrial demand forecast 745 million ounces. Shanghai silver price 92.35 per ounce. U.S. dealer premiums $8 to $11 above spot 3x normal. Make sure you're subscribed to Final Wealth Warning. Hit that notification bell. Drop a comment telling me which of the 6 preparation steps you're going to tackle first and how you currently hold silver. Share this video with every silver investor you know, because most people are walking into the next 12 days completely unprepared. Prepare, not panic. Prepare. Audit your exposure. Secure your storage. Establish dealer relationships. Make your decision framework. Manage your position size. Understand your taxes. And hold your physical silver with both hands. Because what it represents, real, tangible, irreplaceable wealth in a world of paper promises, is about to become more valuable than most people can currently imagine. The spring is loaded. The countdown has started. 12 days to March 1st notice. And after everything I've shown you today, after all the data and all the evidence and all the warning signs, there's only one question that matters. Are you prepared for what's coming? I'll see you in the next